What a day. I mean, was it miscommunication or mismessaging from the Bank of England yesterday? I mean, it's a very tough pill to swallow in saying, guys, please don't ask for a pay rise because it makes my life more difficult as the Bank of England.
Well, I think what we saw yesterday was a bank response, a continuation of the bank's response to a shock to the economy, which is posing us with difficult challenges and posing the UK economy with difficult challenges. I mean, I think there are sort of three big features of where we stand around that. I mean, the first is this is a shock to energy prices and to international goods prices, which have risen much more than expected over the last 6 months, year or so. And those are things the UK imports. So from an economist's point of view, we might call that a terms of trade shock. If things we're buying are costing more than the things we're selling, that is going to weigh on real incomes in the UK. And that is an unavoidable thing. The second thing is that's a big shock. Energy prices have risen very rapidly. Wholesale gas prices rose 400% over the last year.
But Hugh, if we focus just on wage growth a little bit, is there a level of pay increase that the Bank of England would be comfortable with that wouldn't filter through inflation too much so that you have to be much more hawkish?
Well, I mean, I think the key thing is, given the nature of the shock we're facing, real incomes in the UK will suffer to some extent. That is unavoidable. There's nothing that policy in general, or monetary policy in particular, can do about that. Who suffers that cost is something that monetary policy can't really have much say about, the distributional effects of that. What I think monetary policy can and should focus on is ensuring that we don't see a repeated attempt, which is inflation generating by different groups, different workers, firms, etc., to try and shift the burden of that shock onto others by pushing up their wages, pushing up their margins, whatever. So we are trying to avoid the emergence of these famous second-round effects from the energy shocks in order to keep inflation falling towards target as the direct impact of the energy price rises drops out of the calculation of inflation. And that helps us create the sort of more stable macroeconomic environment, which I think is to everyone's benefit over the medium term.
Hugh, a lot of traders are trying to figure out, first of all, the sequencing, some of the corporate bond selling, what that exactly means. But where do you see the neutral and terminal rates?
So I think, my own view on that is that we have to be cautious in communicating where R star or the neutral rate is. The forecast we put out yesterday, had three big moving parts. It had this energy price shock we've already discussed. There's a lot of uncertainty about that. And we showed these two different scenarios, which I think showed the sensitivity of the inflation outlook to different paths of future energy prices. We also, as we've just discussed, had some assumptions around the outlook for wages. Our forecasts embraced the fact that the labour market today is tight. It's tighter than we expected back in November in the course of our forecast last year. And I think it's expected to tighten further over the next few months. And that's led the information we get in our surveys of firms and so forth to see the expected wage increases over the coming months are going to be elevated.
And that's clearly what you're concerned about. But there's a difference between saying, and good morning to you, Hugh, there's a difference between saying that you're concerned about inflation and second-round inflation effects and higher wages, and telling people not to ask for pay rises when they feel the pressure and they feel the cost of living going higher. Do you think maybe that message should or could have been worded a little differently?
Well, it's not for me to criticise my boss, so you're not going to get me to do that. What I do think is that, a key assumption in our forecast and a key element of why, admittedly, on a path of interest rates that is derived on market expectations, which involves further increases in rates, which our communication yesterday also acknowledged and to some extent embraced. I think it is key to see that the assumption we have is that we don't see, from the middle of next year, persistence emerging in wage and domestic cost developments stemming from these second-round effects. And it's that lack of that, the fact that policies, including monetary policy, do enough to avoid that, that is central to bringing our inflation back towards target. If we were to see developments that were not consistent with that assumption, then of course we would have to think about further action. So
that's why you're so focused on the pay restraint point. You mentioned the expectations in the market about hikes. Are you happy with where the market is positioned post the meeting? Because in the 2021-22 cycle, we're now looking at 6 hikes in 7 meetings. That's more than in any hiking cycle since independence for the Bank of England in 1997. Maybe that's right. These are pretty unprecedented times. Does that sit well with you?
Look, I'm not going to comment at length on the outlook for interest rates as priced. I mean, I think our communication yesterday had two elements, and I think probably both elements need to be taken into account in coming to some sort of assessment from the market point of view. As I've already said, we are not running away from the fact, and indeed we state that in the coming months, and as long as things play out broadly as we expect, we would expect to see a further modest tightening of monetary policy, which would embrace a rise in the bank rate. But I think it's also important to see, in parallel with that message, we published a forecast. That forecast, of course, is based on assumptions about interest rates, it's based on assumptions about wages, it's based on assumptions about energy prices. Those are the three big moving parts and interrelated parts in our forecast. But that forecast led to an outlook for inflation in 2 to 3 years' time that is below target. So when the governor says markets should not get carried away, I think they need to take into account that our view of the world, conditioned on the fact that energy prices stabilise or perhaps fall from here, and conditioned on the fact that whether taking his advice or not, we do not see the emergence of second-round effects in wage and domestic cost dynamics, inflation will fall back towards target and potentially below it on how markets were pricing when we were making that forecast back at the
So, Hugh, on the back of that, is the Bank of England actually happy to have the most negative real yields in the developed world?
Well, I think we are going to set policy, both with short-term rates, bank rate, and with other dimensions of policy to achieve our target. If at the moment that requires us to have real yields to sustain recovery, then I think we're comfortable with that. I think, we are looking through time for, as that recovery progresses, to see a normalization of the economy, inflation return back to target, and hopefully, as the very long legacy of the financial crisis, Brexit, and COVID recede, back to a more normal level of real interest rates, which hopefully would be positive, reflecting positive returns in the British economy.